In this short video, we're going to find out how to calculate depreciation using different methods of depreciation for an asset that you bought right now. And depending upon the life of the project and tax life of the asset, we're going to figure out book value of the asset at any point in time. Let's start with an asset that cost us $325,000 to buy. Let's say the project we have has a life of 7 years and tax life of the asset is 10 years. Let's handle the straight line depreciation. Straight line depreciation is simple, as the name suggests. Throughout the tax life of the asset, every single year, you divide the cost of asset by the tax life and you apply that percentage as depreciation. So for straight line, we're going to take the cost of the asset. Let's make sure, let's fix it, divide it by the tax life of the asset. Every year, we're going to charge $325,000. If you want to be fancy, we can make sure if the number of years is less than or greater than the tax life of the asset, then depreciation is 0, otherwise straight line. In this spreadsheet, I basically did it up to 21 years, and you're gonna figure out why 21 is correct. Of course, I didn't pay attention to making this fixed. So after 10 years, there is no depreciation. Now, given the depreciation for each year, at the end of each year, we could calculate the book value of the asset. This is important for the purposes of calculating any possible taxes on salvage. You buy the asset now, you sell it 5 years from now. The question is whether or not, A, you made any profits on the sale, B, if you did, are there any taxes? IRS uses book value as basis for tax calculations. At the end of year 1, you deduct from cost of the asset the depreciation for that year. So if you sold this asset for $300,000 at the end of year 1, as far as IRS is concerned, you made $7,500, and you will pay taxes on that amount. Year 2, you start with year 1 book value, deduct year 2 depreciation, and so on. Obviously, under straight line depreciation, at the end of year 10, you will actually have 0 book value. So if you sold this asset for any value at the end of year 10, as far as IRS is concerned, your cost is 0. So any revenue that you got from the salvage is considered taxable. Now, IRS also has different depreciation schedules. These are called modified accelerated cost recovery system. Let me show you the table, and I'm gonna make this table available to you. Certain assets have 3-year makers. For example, computers would be in this category. Even though it's a 3-year makers, you actually write off the entire asset in 4 years, but you do it at an accelerated pace. The first year is not any different from 3 years straight line. You deduct exactly 1/3 of the asset, but second year is much higher and then much lower. In this case, let's have the tax life of the asset for straight line 10. For makers, tax life of the asset is 11 years because I'm going to assume that this asset has a 10-year maker's schedule. You're going to write it off exactly in 11 years. So if this is greater than the tax life, you're going to have 0 depreciation. Otherwise, I'm going to read it off from here. Right now, I just have the percentage. I'm going to multiply with the cost of assets. As I said before, the first year is exactly the same. And at the end of year 11, you pretty much depreciated all of it. And book value again is the same. First year is cost of asset minus depreciation. Second year, book value at the end of first year minus depreciation for second year. And so on. As you can see, at the end of year 11, book value is indeed 0. You can do this yourself for different asset lives. For example, if tax life of the asset was 7 years, I'm going to use different percentages, or 8 years, I'm sorry, because 7-year makers is an 8-year tax life. As you can see, at the end of year 8, the asset is completely written off by depreciation. And this is going to be very useful for our after-tax salvage value calculations.